Listen carefully, because what's happening in silver right now is not normal. And it's not random, and it's definitely not organic anymore. On the surface, everything looks quiet. Prices move slowly. Volatility feels muted. Most people glance at the chart and think nothing's happening. But that's exactly the trap. It's because the most dangerous phases in any market are the ones that feel boring. Real markets breathe. They react. They overshoot. They correct. They reflect fear, greed, uncertainty, and surprise. What we're seeing in silver right now doesn't behave like that. Instead, price moves feel restrained, timed, almost guided. Rallies stall at predictable levels. Drops appear suddenly, often without a real catalyst. And the moment momentum tries to build, something steps in and shuts it down. That's not natural price discovery. That's control. And here's the key thing most people miss. Markets only need to be controlled when the underlying pressure is growing. No one manipulates something that isn't dangerous. No one spends effort suppressing an asset that doesn't matter. The very fact that silver price action feels artificial is the signal itself. Let's take a step back. Silver is not just a shiny metal. It's an industrial input. It's a monetary metal. It's a strategic resource. It's embedded in energy systems, electronics, defense, medicine, and infrastructure. Demand doesn't just come from investors. It comes from the real world. Factories don't speculate. Governments don't hedge for fun. When they need silver, they need it physically, not on paper. But price doesn't reflect that reality anymore. Instead, what we see is paper volume dominating physical reality. Massive amounts of silver exposure trading hands without a single ounce moving. Contracts stacked on top of contracts. Promises built on promises. And as long as people accept paper claims instead of metal, the illusion holds. But illusions require maintenance. And lately, that maintenance has become aggressive. You'll notice something strange if you watch closely. Whenever silver starts to gain real attention, not just trader chatter, price is quickly pushed back down. Not gradually, not emotionally, mechanically, almost instantly. As if someone doesn't want momentum to form. Because momentum brings scrutiny. And scrutiny brings questions. And questions bring physical demand. What they can't allow too early. Because once physical demand accelerates, paper control weakens. And once paper control weakens, price doesn't rise politely. It snaps. This is why the current price action matters more than price level. It's not about whether silver is at this number or that number. It's about behavior. And the behavior right now is defensive, contained, artificially calm. Think about it as if silver were truly weak. No intervention would be needed. Sellers would do the job naturally. Price would fall smoothly. Interest would fade. But instead, interest keeps returning. Buyers keep stepping in. And yet price goes nowhere. That tension is not sustainable. Something is absorbing pressure behind the scenes. And here's where it gets more important. Controlled markets don't break slowly. They hold, and then they gap. They don't warn you with gradual moves. They lull you into thinking nothing's wrong, till suddenly everything changes. This is the phase where most people lose patience. They say silver is dead money. They move on. They stop paying attention. And that's always when positioning quietly shifts, from weak hands to strong ones. From emotional traders to entities that don't care about short-term price at all, because those entities aren't trading charts, they're securing supply. And when supply matters more than price, price becomes secondary temporarily. That's why price action no longer reflects reality. It's not meant to. It's meant to buy time. Time for inventory. Time for hedging. Time for preparation. Time for exposure to be reduced before the next phase begins. You don't control something you've already solved. You control something that's still a threat. And silver is still a threat. In fact, silver is uniquely dangerous to a system built on leverage and confidence, because silver exposes physical limits. You can print currency, you can roll debt, you can extend promises, but you cannot print ounces. You cannot roll delivery forever. Eventually, someone asks for the real thing. And when enough people do that at the same time, the game changes. Right now, price action is sending one clear message not to the public, but to those watching closely. Do not let this move yet. That's not weakness. That's containment. And containment always fails eventually. Because pressure doesn't disappear, it accumulates. And when it releases, it never releases gently. To understand why this phase is so dangerous, you have to understand how artificial calm is created in the first place. Because this calm isn't natural and it isn't accidental. It's engineered. And it only exists as long as confidence exists in the paper system holding it together. Paper markets were designed for liquidity, not truth. They were meant to make trading easier, smoother, faster. But over time, liquidity replaced reality. Instead of price reflecting supply and demand of metal, price began reflecting the flow of contracts. And once that happened, price stopped being a signal and started becoming a tool to manage perception. Because perception is everything in financial markets. If people believe supply is plentiful, they won't rush to secure it. If people believe prices are under control, they won't panic. If people believe nothing is happening, they won't ask uncomfortable questions. And silver depends on people not asking those questions. Right now, the paper market is doing most of the talking. Huge volumes appear out of nowhere. Selling pressure hits in clusters. Breakouts fail at levels that feel almost scripted. This isn't traders reacting emotionally. This is structure reacting defensively. And here's the part that matters. This kind of control only works when participation is passive. It relies on most people being observers instead of actors. As long as people watch the chart instead of touching the metal, the system can keep absorbing stress. But that balance is shifting. Industrial demand doesn't care about charts. Manufacturers don't hedge production needs emotionally. Energy infrastructure doesn't pause because price looks inconvenient. If silver is needed, it's needed regardless of whether price action looks healthy. And that demand doesn't show up in candlesticks right away. It shows up in tighter inventories, longer delivery times, it's quiet accumulation, smaller buffers, less margin for error. That's the invisible side of this market. The visible side, the price is being restrained. The invisible side, the flow of metal is being drained. And that gap between the two is where instability lives. Because when paper says plenty and reality says tight, the market isn't balanced, it's fragile. This is why price action feels wrong to so many people right now. It's not matching what's happening underneath. Moves feel delayed. Reactions feel muted. Bad news doesn't move price the way it should. Good news is quickly neutralized. That's not coincidence. That's insulation. Insulation is used to delay heat transfer, but it doesn't stop heat from building. It just traps it longer, and the longer it's trapped, the more violent the release. This is why seasoned market participants don't relax during calm phases. They become more alert. Because calm doesn't mean safe, fit means compressed, and compression always resolves. Another thing you'll notice during these phases is narrative confusion, conflicting explanations, constant noise. One day silver is weak because of rates. The next day it's weak because of growth. Then it's strong but only briefly before being pushed back down again. The story keeps changing, but the outcome stays the same: flat, contained, controlled. That's not analysis, that's distraction. When fundamentals stop mattering in the short term, it's because they matter too much in the long term. The system is trying to manage timing, not direction. Direction is already decided by physical reality. Timing is what's being fought over. And timing matters because exposure matters. Because leverage matters. Because someone, somewhere, cannot afford silver to reprice too quickly. A slow rise can be hedged. A sudden gap cannot. That's why sudden moves are suppressed hardest. Not because they're wrong, but because they're dangerous. The most revealing moments are when silver tries to break free. Watch how quickly selling appears. Watch how volume spikes without follow-through. Watch how price is walked back into a narrow range over and over again. That's not a market expressing opinion. That's a system enforcing boundaries. But boundaries weaken with stress. Every ounce delivered removes flexibility. Every long-term holder reduces float. Every industrial contract tightens the margin. Every quiet buyer increases pressure. And none of that shows up clearly on a chart until it does all at once. This is why breakouts in controlled markets don't look like normal breakouts. They don't grind higher. They don't give endless pullbacks. They explode. They gap. They reprice before most people can react. And when that happens, narratives flip instantly. What was boring becomes urgent. What was managed becomes chaotic. What was safe becomes unavailable. And by the time headlines catch up, positioning is already done. Right now, silver price action is telling you one thing clearly if you know how to listen. Not through movement, but through restraint. The tighter the restraint, the greater the pressure underneath. And pressure doesn't resolve sideways forever. It resolves when something breaks. What ultimately breaks controlled markets is never the thing people are watching. It's rarely the obvious headline. It's almost always something subtle, something structural, something that quietly removes flexibility from the system. And silver is a market that survives on flexibility. As long as contracts can be rolled, delivery delayed, expectations managed, and attention redirected, control can hold. But control depends on participation. It depends on trust, depends on the assumption that paper is good enough. The moment that assumption weakens, everything changes. Because silver isn't a belief-based asset, it's a physical one. At some point, someone doesn't want exposure, they want metal. At some point, someone doesn't want settlement, they want delivery. At some point, the question stops being, what's the price? And becomes, is it available? That's the pivot. And historically, that pivot never announces itself loudly. It starts quietly. One missed shipment, one delayed fulfillment, one inventory report that doesn't line up, one unusually strong bid that doesn't retreat, then another, then another. And suddenly, the system realizes it's lost optionality. This is why price control becomes more aggressive right before failure. Not because control is strong, but because it's weakening. The tighter the grip, the closer the limit. Think about it. If everything were fine, there would be no urgency to suppress momentum. There would be no need to lean on paper volume. There would be no reason to cap price reactions so precisely. Those actions are signals of stress, not confidence. What most people misunderstand is timing. They assume that because silver hasn't moved yet, it won't. Or because suppression has worked before, it will always work. But suppression doesn't eliminate pressure, it concentrates it. And concentration is what creates discontinuity. That's why when silver finally breaks out of controlled phases, it doesn't behave politely. It doesn't wait for consensus. It doesn't give people time to reposition. It gaps into a new reality. By the time price reflects truth, truth has already been acting for months. This is why the most dangerous moment is right before the move, when nothing appears wrong. When boredom sets in, when patience wears thin, when people stop paying attention, that's when positioning quietly finishes. Strong hands don't need excitement. They need certainty. And certainty doesn't come from price, it comes from structure, from usage, from necessity, from limits. Silver has limits. And systems built on leverage don't like limits. What happens next doesn't require prediction. It requires awareness. Awareness that this phase is not about upside, yet about setup. Awareness that artificial calm is not stability, it's compression. Awareness that controlled price action is not weakness, it's preparation. And awareness that when price stops being organic, it's because reality is becoming inconvenient. Eventually, something forces alignment. Physical demand overwhelms paper narratives. Delivery matters more than settlement. Availability matters more than charts. And when that happens, price doesn't ask permission. It reintroduces itself. That moment doesn't arrive with warnings. It arrives with gaps, with sudden repricing, with headlines scrambling to explain what participants already knew. The people who benefit aren't the ones chasing the move. They're the ones who understood the silence.